Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. And if you guys are looking for undervalued investment opportunities, financial education, anything, click subscribe. And if you guys have questions, put it in the comment section. I'm willing to do videos to help anyone out on this channel to better understand investments, financial, whatever it is, malarkey, or whatever it is. I'm here to help you guys out. So I'm reading through the comment section. And this, I know some people, I was waiting for someone to bring it up. It says, Andy, I just looked at lumber. It looks like we're at support level right now after a steep decline. Please chart lumber and copper and update the lumber and copper to gold ratio. What do you think? And the reason he's asking most likely about lumber is usually lumber goes up at the beginning of a real estate boom. But we had COVID and there's this weird scenario where the supply got all jacked up. At least that's what is in the news. I don't know the actual thing, but I do know demand for lumber is through the roof. So usually what happens is lumber cracks higher at the beginning of a boom. And then more towards the end, gold outperforms lumber. So it's let me back up and just describe a couple of things here. So ratios in general, we use ratios to identify relative value. And a ratio is just an asset priced against an asset. And depending on how these assets perform against each other, we want to be in the asset that's outperforming. So if one's very overvalued and one's very undervalued, we want to invest in this one and then have it go like this over time, where this becomes overvalued and this becomes undervalued. And then we sell this asset and buy this asset. And then it goes again. Sell this asset, buy this asset. And it goes back and forth over time. And that's how you make purchasing power gains, where you invest in the undervalued asset, wait for it to become overvalued, and you can buy more of other assets. That's the entire purpose of investing. If you don't know where you are ratio-wise, you don't know if you're making purchasing power gains. And there's no point of investing if all you're doing is making paper dollar gains that buys less of other assets. Hopefully that makes sense. So we use ratios to determine what's outperforming what. So what asset's outperforming the best, or what asset is going to outperform others. We look for chart pattern breaks. We look for things to break their resistance levels. When you have a cheap ratio, it means that the money has flowed out of that sector. The money's gone. It moves somewhere else. And then in the other sector, which is very overvalued, the money went to that sector. So at this time, commodities, money's flowed out of commodities and it went to stocks. Stocks are never been more expensive in history in relationship to other assets. In relationship to real estate, stocks have never been this expensive. In relationship to commodities, in relationship to anything. What I am proposing is that money that's all gone to stocks is going to eventually rotate into the undervalued sectors, which is commodities and real estate and whatever else is undervalued. So over time, we're going to see commodities outperform stocks for a period of time. That length is probably around 5 to 10 years because it usually happens when interest rates go up under an expansion phase of real estate. So lumber gives us signals saying that we're going into an expansion phase of real estate because as we build more homes over the average, the demand for lumber goes up, which signals that the price of lumber should go up. So looking at this presentation I put together, this is the price of lumber behind me. There's lumber right there. You can see that I drew in a trend line. It was kind of, and this was the last commodity bull market at the end. You could see lumber starting to decline. And then we came back up and we've been going sideways with lumber for the majority of it. And then you could see a nice big, 2016 was the bottom of real estate foreclosures kind of drying up. It was just starting to get dried up. Prices started to increase slowly from 2016 onward. And we started to see a more rampant change in the 2019-2020 era of real estate prices. you can see the same thing happen with lumber. We started to build more and more new homes, and you can see the move in 2020 since COVID really started to move higher. If there's a shortage in lumber, it was caused because of COVID, not because of, let's say, in a huge amount of demand. Now, there is a lot of demand, but looking at the housing starts, which is right here, if you were to draw a line in here, I'll do that. If you draw a line in here and say, all right, the average is about here. This is the average yearly demand. This area under the curve here needs to be built over the curve over here to equal and balance out this entire market, because there's about 1.4 million, 1.3, it depends where you look, average yearly demand for new homes being built. But we underbuilt all through 09, 2010, 2011, 2012, all the way till about 2019, 2020. So we have to build 4 million new homes, and we haven't built them yet. So this indicator for lumber coming on down, it's from such a high state that I don't think that indicator is a worthwhile indicator at the moment. It signaled that we were building more homes, but it was an acute shortage of lumber all in one shot. So I don't think this is a long-term bear market for real estate. It's just getting started. So I do think that lumber is going to come down as we open up, they hire more, and we start to produce more lumber. So I think the lumber price will go down, and then people are going to buy more new homes. That's my guess. Now this is the lumber price right there. This is the gold. I just wanted to show you gold and lumber. Gold's right here. It's been coming on up. We've got large up days and then the two small down days there. I think the buyers are still in control, and it's going to probably head higher. This is on a weekly basis. It's just going to take time. You have to be patient. Here's the gold to lumber ratio, looking at the relative performance between lumber and gold after looking at the price charts. Lumber is definitely outperforming. It broke to the downside all the way down here. This could be an all-time low, meaning that lumber's never been more expensive in relationship to gold ever. So what I would have done is swap my lumber to gold if I owned lumber and gotten out of lumber, because the ratio is saying that it's never been that expensive in relationship to gold. And it's probably going to come back up and go in this, but we are in a downtrend. You can see this thing downtrend coming through this line here all the way since 2010. So lumber has been outperforming gold since 2010. That's why it's declining over time. Here is the gold to copper ratio. I know we wanted to look at that. I think I did it in another clip here recently. But copper's outperforming gold, which means that the economy is strong, or it's stronger than it was before. And that we're seeing a change in the dollar. So when copper outperforms gold, it's an indicator, we call it Dr. Copper, that commodities are most likely going to outperform stocks. Platinum to gold is another ratio that you can use, and I didn't chart that here. But that's also another one that indicates that commodities are going to outperform stocks and bonds and other investments. So what I would be looking at, I wouldn't necessarily use lumber as an indication that we have problems in the real estate market. That it was at an anomaly in history of how expensive lumber got. Lumber's pulling back. It's probably going to come to a more normal level when the supply-demand balances out, and we're still going to have to build the 3 to 4 million homes above the average. It's still an expansionary phase. I see everything intact, and keep in mind some of these, if you chart them on a very long-term chart, and what I mean by some, like the copper to gold ratio, since 1970, this thing looks like it's going to explode higher. I don't think that you can have a chart that large be wrong. And I don't think it's just going to come up and then fail. It could come up and pull back, very well could pull back. And then we move on up over time, because the homes have to be built. Now, there was another Let me see if I can pull it up. I think I still have the chart here. It's not that one. Hopefully it's this one. There it is. Here's another chart that I was looking at. Of course, I'm blocking it. Let me zoom in here real quick. So this is, someone was saying this is the purchase demand powered by demographic wave. And someone was saying the demographics don't support a increase in real estate. Yes, they do. Here's your data right here that I got. Chart is from Jeff Tucker, an economist at Zillow, showing the surge in prospective millennial home buyers. What the people are doing wrong on YouTube and the clip that this guy shared about demographics not supporting it, he used the wrong demographics. He said, look at this, the demographics goes down, but none of these people that are 9, 12, 15 years old are going to be buying homes. You have to constrain it to the people who are in home buying years. And these people over here own more homes than these people over here who own more homes than these people over here who own more homes than these people over here. And they continually go up over time. What I am saying is that this in the yellow here, the median age for first-time home buyers is 34 years old, which is this age right here. I would have gone a little bit up to about 39. So 39 to here is a higher population in this group here than it is in this group here. So the demographic did go up in terms of buyers. We have more people entering the market that are new first-time buyers than ever before. The demographic does support it. Now, after this demographic, after the millennials go through, we're going to have less people, which means house prices are probably going to remain flat or go down. It's going to be more like a Japan-style look, unless you get a bunch of people migrating here from somewhere else. So the demographics does support higher real estate prices. Now, if you look at real estate and you look at the inventory of real estate, we have record low inventories. The demographic is coming in here and buying it. We can see the percent of home ownership go up. So the thesis of inflation comes from residential real estate land values, and that an expansionary phase where we have new homes being built and new loans going against new homes, everything's intact. Now, someone said that correlation isn't causation. I'm not using correlation and saying that that's the cause. Fractional reserve lending does increase the money supply. That is a fact. Another fact, the majority of money, it's like 95 to 99% of all money created came from commercial banks being loaned into existence through fractional reserve lending. That's a fact. Another fact, over 60% of commercial loans goes against residential real estate residential real estate. If that's the case, if those are all facts, then the largest contributor to inflation is residential real estate land values because it makes up over 60% of commercial bank lending in its entirety. Therefore, my thesis could be considered fact. If those are all facts, yes, money gets expanded from residential real estate. And when money comes into the system, it is inflationary. Inflation drives the price of all goods and services higher. It could be food, it could be copper, it could be oil. It drives everything higher because the supply of money goes up. It's a monetary inflation. You can't have inflation without monetary inflation. And I would love to see someone prove otherwise, and you can't have deflation either. The money's still in the system. It has to go somewhere. It goes into a bank, gets loaned back into existence. It goes into investments. That money went into investments. It increases the price of stocks. The money goes somewhere. These people who say that prices are an indication of inflation or not, I just don't think they're right. I don't think they understand Now, they're right with the way that they define it today, which they define it using prices. But prices can't go up without monetary inflation. If monetary inflation doesn't happen, prices can't go up in aggregate. If you guys like this content, please give me a thumbs up. Help me out. If you guys want more information, please put it in the comment section. Leave questions. Ask me whatever you need. I'm here to help you guys out. Let me know what you need, and I can give you my best opinion. Thanks for listening. This is Finding Value.